Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Teledoc. Teledoc reported its results Q3 yesterday. We're going to talk about its results. We're going to talk about its guidance for 2022. We're going to talk about its profitability and how that fares up. And then we're going to talk about its valuation. So I'm just going to jump right in. So they talked about in the earnings call that they're guiding for 2.6 billion in revenues for 2022. Okay, so if you think about it, back in Q3 of last year or 2020, they bought Livongo for approximately 14 billion, and that was obviously a huge needle mover. And you can see here from Q3 2020, it was really putting out explosive growth rates. What's more, you also had social restrictions in place, so that just those two dynamics, the inorganic acquisition plus the overall COVID trade, really pushed forward their growth rates. Okay, so coming up against that heavy comp for Q4, they're pointing for the guidance to be up 43% year over year, which is pretty strong, I believe. It's clearly growing at a rapid rate. The question is how rapid and how sustainable. In order to appease investors on that front, they said, okay, so we're going to put out 2.6 billion revenues next year. So it's kind of pointing towards 28% year-over-year growth rates into 2022. They probably guided that low enough to allow for easy beating along the way. So for all intents and purposes, probably looking at around 35 to 40% CAGR. Let's say 35, somewhere around that, probably high 30s. So with that in mind, you got plenty of visibility, you got reasonable fast growth rates, and it's a space that has a long runway ahead. So I think that investors are quite despondent here, and I don't think that's necessarily right to be so despondent. I think that when everything is said and done, it's not such a bad investment, okay? So here's the thing, right? It's not a bad investment, but the share price is down significantly. So you can see since February, it's just been tanking. This is pretty much all these high growth companies since February just been tanking. That being said, since July, I've been reporting this quite a lot. Since July, I've seen the market starting to be more discerning. Things that are no-brainer investments, even in the high growth space, are getting re-rated higher, and things that investors are not 100% sure about, they're kind of not really that compelled about. So with that in mind, the investors are really gloomy here because I think that there's a lot of potential within the company. Just one metric that I wanted to highlight. Okay, so everyone was saying, Teladoc is just a COVID trade, and it ultimately, you can see utilization is still going up over time. So members are still using the platform, and it's not a COVID trade. When everything is calmed down, you can see that people are becoming more familiar with the platform. We're using the platform a lot more. So it doesn't stack up with that narrative, right? The other thing that I wanted to highlight is that everyone said, Teledoc is a very high gross margin business. Not sure about that. So you look here, so they put out 68% of adjusted gross margins, but the EBITDA figure that adds back all the stock-based compensation is at 13%. So it's not quite what I would say a high margin business. So this is just something for you to kind of think about. One thing that I wanted to highlight, so they already discussed at the start of the video, they made the acquisition of Livongo, so it has some net debt on its balance sheet. So it's not a lot, but it's something for you to think about. Okay, so it has 400 million of net debt, but it's cash flow generative. But it will, to some level, kind of put a dent on its ability to be highly acquisitive going forward. It still has some wiggle room, but it's not kind of going to be. They don't have a lot of flexibility here in what they can do. But as I'm mentioning, its price is less than 9 times forward sales. So you've got a business that has a lot of visibility, strong tailwinds, price is 9 times forward sales, and it's growing close to 35% CAGR. So I think that it's not that bad. One thing that people often comment when it comes to Teledoc is that this year over year, for instance, for Q3 21, the revenue was up 81%. Okay, at the same time, stock-based compensation was up 4 times. So you're paying 4 times more in stock-based compensation for it to grow 81%. So it's kind of like, yeah, they're paying a lot for their staff, and that's something that people have often highlighted, even within tech companies, that this is like really expensive. And I know that it's going to kind of come down a lot because a lot of it was driven by the Livongo acquisition, and that will peter out quite quickly into 2022. But it's something, you know, that investors have noted. So I'm not sure if I put it here on the graph. Let me just see if I've got the cash flow statement. No, I didn't put it up. But yeah, you can just look through and you can see that on a gap basis, they're not really growing towards profitability. So it's kind of like they're investing for growth, and you're going to have to take a kind of a buy and hold investment thesis here. You're going to have to be quite patient here for them to start really capitalizing on that scale that they're gaining and starting to see that profitability improving. So all in all, I think this is kind of like, if you have the patience, this could be something that is attractive, but I believe that there are probably better investment opportunities out there. So with all that, if you want to find out what those better investment opportunities are, don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor, help you think through investing, create a process of what to do, what not to do. Okay, so with that aside, I hope to see you throughout the earnings